Hello, everyone, and welcome to Financial Accounting. Our topic today is Introduction to Financial Statements. We're going to look at the three fundamental financial statements and learn how the accounting equation works. There are three fundamental financial statements used in accounting: the income statement, the balance sheet, and the statement of cash flows. Note that some textbooks also mention a statement of retained earnings as the fourth statement. The income statement shows revenues and expenses. The balance sheet is a listing of all asset, liability, and equity account balances that don't appear on the income statement. The statement of cash flows show how the company receives and spends its cash. In this video, we will look at the financial statements of a corporation. The balance sheet describes the financial position of a company at a specific point of time. A balance sheet may be prepared monthly, quarterly, or annually, depending on the needs of management and external users. The balance sheet is sometimes referred to as the statement of financial position. It is important to note that financial statements begin with a three-line title comprised of the company name, the name of the statement, and the period covered by the report. If you don't include this information on the statements are considered incomplete, and the users of financial statements will not be able to use them. We will look closer at the three-line titles when we review financial statements later in this video. In the long run, revenues will generate positive cash flows to the company, and expenses will result in negative cash flows to the company. Just remember, revenues and expenses that appear on the income statement may not always produce cash flows in the current accounting period. Net income or net loss is simply the difference between revenues and expenses. When revenues exceed expenses, the result is net income. When expenses exceed revenues, the result is net loss. The statement of cash flows is divided into three major sections. 1. Cash flows from operating activities. 2. Cash flows from investing activities. And 3. Cash flows from financing activities. The statement describes cash inflows and outflows over a period of time. Let's first look at the balance sheet. Note the three-line title comprised of the company name, the name of the statement, and the period covered by the report. The balance sheet is reported as of a certain day and includes everything from the day the company started its operations. The statement of financial position, commonly referred to as the balance sheet, is an inventory of asset, liabilities, and equity at the end of the accounting period. In this example, our total assets are equal to $300,000. This includes cash of $22,500, notes receivable of $10,000, supplies of $2,000, and the balances in the remaining asset accounts. Liabilities include notes payable of $41,000, accounts payable of $36,000, and salaries payable of $3,000. The accounts in the owner's equity section of the balance sheet are capital stock of $150,000 and retained earnings of $70,000. Notice that the total assets are equal to the total liabilities plus owner's equity. The business entity principle states that the transactions of individual owners of a business and those of the business must be separate. Assets are resources owned or controlled by entity. They include such items as cash, accounts receivable, which are amounts owed to the company by customers, land, building and equipment, and supplies. In our example, we have 300,000 in assets. The cost principle tells us that accounting information is based upon actual cost incurred. We refer to this as historical cost. The going concern assumption states that in the absence of information to the contrary, the business entity is assumed to continue operations into the foreseeable future. The objectivity principle states that accounting information must be unbiased and based upon independent evidence. The stable dollar assumption tells us that we will only record accounting information that can be expressed in monetary units, usually dollars in the United States. You might also want to watch the video called 8 Accounting Concepts. I am posting the link right here and in the description to this video. Liabilities represent the claims of creditors on an entity assets. Liabilities include accounts payable, which are amounts owed to creditors for assets purchased on account, taxes payable, and wages payable, which are amounts owed to our employees at the end of the accounting period. In our example, we have 80,000 in liabilities. The equities of an entity include investments by owners, withdrawals by owners, and earnings retained by the business. Investments by owners and net income increase owners' equity. Payments to owners and net losses decrease owners' equity. In our example, we have 220,000 in owners' equity. Now let's look at the accounting equation. The basic accounting equation states that assets are equal to liabilities plus equity of a company. We will take a closer look at the accounting equation in the video, The Accounting Cycle, Capturing Economic Events. I am posting the link to this video right here and in the description to this video. In our example, we have 300,000 in assets, 80,000 in liabilities, and 220,000 in owner's equity. If we add liabilities and owner's equity, it is 300,000. The accounting equation balances. The equation makes sense because it states that assets must be equal to the claims against those assets. There are two broad categories of claims against an asset. Claims by creditors, called liabilities. After all creditor claims are satisfied, the residual owners, the stockholders, have a claim on those assets. Financial statements are only one source of information about the operations of a company. To have a better understanding of how a company is doing financially, the financial statements of the company can be compared to those of other companies in the same industry, major national or international competitors, and to the norms for the national economy. There are three general forms of business operations: a sole proprietorship, a partnership, and a corporation. A proprietorship is a business owned by just one individual. A partnership is owned by two or more individuals. Some partnerships are very big and have several thousand partners. A corporation is owned by individuals who normally are not active in the day-to-day operations of that business. For example, you may become an owner of IBM by purchasing shares of stock on the New York Stock Exchange. While you are a part owner, you don't necessarily work for IBM, nor are you active in the operations of the company. The owner's equity section of the balance sheet will look different for each type of business entity. For a sole proprietorship, there will be a capital account for the owner and a drawing account to record payments to the owner. For a partnership, each partner has a separate account where changes are tracked over time. There's also a separate drawing account for payments made to each partner. A corporation will show owners' contributions in the capital stock account and accumulated earnings of the company in the retained earnings account. You should be able to tell the form of a business by looking at the equity section of a balance sheet. Creditors and investors have two major concerns about the operations and financial position of any company. First, the company must be liquid, that is, it must be able to pay all bills when due. Second, the company must be profitable in the long run. Unprofitable companies drain the cash position of the company, causing concerns on the part of creditors and investors. In addition to the basic financial statements, companies prepare notes to the financial statements. These notes are meant to provide the reader with additional insights into the operations and financial position of the company. Thank you for watching this video. I hope you found it helpful. Don't forget to like, subscribe, and watch other videos posted on my channel. Click on the notification bell so you don't miss the next video. I will see you soon.